morning and welcome to MarketCast 36, and it's beginning to look a lot like Christmas. No, seriously, don't sing. Don't spoil what we've spent 3 years creating doing these MarketCasts, Matt. But it is beginning to look a lot like Christmas, and the production team here suggested that I did this instead of this Christmas black and gold number in a cable knit sweater in a rocking chair with a pipe next to an open fire. Maybe that's something that we'll do in Christmas 2026. In the meantime, I do bring festive cheer. It's been a little bit tricky the last few months, bringing you nothing but downbeat news with a market that has been absolutely suppressed, struck by budget paralysis, really difficult rates of sale pretty much across the entire UK. I have better things on my horizon, that's for sure. But let's not get ahead of ourselves. Let's start here. It was the damp squib to end all damp squibs, wasn't it? It should have been fireworks night that we had the budget, because we'd have all been preparing to go, ooh, ah, and we'd have just gone, really? Absolutely nothing. If you remember, we did a piece on Rachel's rumour mill, didn't we, before the budget actually happened? These were all the things that were being rumoured, being the flags that were being flown just to see how the public and the press reacted, and the OBR, of course. They were talking about changing stamp duty rates. They were talking about moving the liability from stamp duty from buyers to sellers. They were introducing a UK-wide property tax and doing away with stamp duty altogether, taking capital gains tax relief off your main residence, all of those things. And then in the event, what happened? Well, stamp duty didn't change. But of course, secretly, sneakily, it did, didn't it? Because you get fiscal drag. So all the stamp duty limits were left exactly the same as they were. But in reality, what that means is with inflation, more people get dragged into stamp duty every year, just in the same way as they did with income tax rates too. No first-time buyer help. So still, this government has no help for first-time buyers to get on the ladder, no capital gains tax change on main residence, no wealth tax as such. So they're not, but it's sort of, let's put wealth tax over there and let's call it a mansion tax instead. And of course, in 2028, that's how long you've got to wait. Let's hope that we're still market casting in 2028. There's going to be a mansion tax. So properties worth in excess of 2 million are going to find themselves with an annual bill of about £3,500, and it goes up to properties worth in excess of 5 million with an annual bill somewhere around £7,500. So all of that's going to happen in 2028. Let's see if we all remember that. And then of course a sneaky little 2%, an additional 2%, just to hurt the landlords, just in case they hadn't hurt them already enough after introducing a further 2% on stamp duty for investors at the last budget. Remember? If you're an investor, I bet you remember. And now it's 2% on income that's associated with property. So that's what happened in the budget. Damp squib made no difference. Well, let me tell you, it did make a difference. And we did an extraordinary thing. On budget day afternoon, at AF Oliver here, the beautiful Christmassy offices, by the way, of AF Oliver here in Bournemouth, we actually put together a synthetic market research program, and we had discussion groups, synthetic discussion groups of first-time buyers, second steppers and downsizers to ask them what they were going to do about their property plans in light of the budget, and we'll come to that a little bit later. I don't want to turn this into a full market research market cast. We still want to talk about what's going to happen to the market, especially as I feel I've got some better news for you, but we will take a look at that. It's very important for all of us that are looking at it today. So a very quick run through, a summary. We'll dash our way through the classic indicators just so that we give ourselves that platform, a little bit of backstory about why I feel the market's going to go the way it is. So budget then, mansion tax aside, turned out to be all spin. Budget paralysis, though, wasn't spin. That was for real. And I think the government have really gone stand in the mirror and give themselves a serious talking to, because that has really hurt the industry over the last quarter. But let me tell you, on the foot on the hose principle, when that foot comes off the hose and the water comes through, first quarter of next year. We'll come back to that. Consumer confidence, it had a little bit of a gain in October, surprisingly, didn't it? It's lost all that. It's given its 2 points back in November. Interest rates stayed steady, didn't it? It stayed at 4%. But we've got an interest rate review coming up in a couple of weeks' time, or in fact, just over a week's time. And that, I believe, we're going to see the cut. We're going to come under 4%. Inflation drops to 3.6 from 3.8, and that OOH that I always harp on about, the owner-occupier housing costs, continues to plummet. I'm going to use the P word. I don't care. It's Christmas. And crucially, that suppression of the needs-based buyers. And I'll come back to the difference between needs-based buyers and wants-based buyers later, but that suppression is going to mean that those needs-based buyers are still there for the nimble and the quick thinking amongst you. Okay, let's have a quick look then at the dates, a review of where we're going next. First of all, in terms of inflation, the inflation numbers come out on the 17th. So what's that? 8 days away. So next Wednesday. As the inflation numbers come out, of course, we get the interest rate review the following day. But let's look at the inflation numbers first. That's the OOH number that I've been talking about. Just take a look at where we were when that peaked in 2024, into double figures. And here it is now, that OOH number now is down below 5%, 4.8%. The RPI, the measure that all the newspapers pick up, and with the CPI rather, the measure that all the newspapers pick up, dropped from 3.8 to 3.6%. And even the RPI, which is what the resident doctors like to use when they're calculating their reasons for going on strike, even that is falling too. But so you can see the trajectory, the inflation trajectory is very much down. We head down towards the government target. And what that means then is the following day after the inflation numbers are released, interest rate, the MPC meet to decide on interest rates. It's going to be a 25-point cut, or this isn't a Christmas shirt. I'm telling you, I'm staking my Christmas shirt on there being a 25-point cut in December. So it means we'll head into the new year with the newspapers picking up that headline. There is already fierce competition among the lenders out there right now in terms of bringing mortgage rates down, trying to chase that business. I think that gives me another really good reason for what I'm about to suggest might happen in the first quarter of next year. Okay, so MPC meets. This is where the current average mortgage rate trends are going. I put these charts up not to spend too much time on. There is only one thing that I want to draw your attention to. This chart over here, that orange line at the top shows you where 10-year money is at the moment. So the markets still think that longer term, that 10-year money is up there close to 5%. And that shows you where the markets think longer term that rates are going. But right now, you can see you can get a 90% loan to value mortgage fixed for 2 years at under 4.5%. And I think that's only going one way before the end of the year. And there are mortgages out there. If you go out, look for them, introductory offers and so on, sub 4% right now. So that really does give a very good environment, particularly for first-time buyers and so on. So where does that leave consumer confidence? Now, I'm not going to spend long on the consumer confidence chart this morning. Number one, because we've got our research to talk about. But number two, this data, or these data, I should say, were collected before the budget. So anyone that's answering this survey here is wondering what there's going to be in the budget, and that is bound to affect confidence, that uncertainty. But the numbers, as you can see here, were collected in between the 30th of October and the 14th of November, so almost 2 weeks before the budget. And really quickly then, so the overall index score, the red line there, for those of you that have not seen this chart before, this yellow line through the middle is 0. The GfK asked 2,000 people, are things going to get better or worse? If they say better, that gives it a positive number. If they say worse, it's a negative number. So if the lines are below this yellow line here, it means the majority of people, of that 2,000 people, think things are going to get worse, not better. If the indicator is above that yellow line, they think the majority think things are going to get better. So we're well down in the negative, and we have been now pretty much since COVID. 2023 got a bit better, but we've been well into negative since COVID. And you can see here, this is the red line, the overall index score, which came down 2 points in the last survey, really low. So the UK economy score, this blue line down here at -32, is the lowest it's been since the Truss Kwarteng mini budget in 2022. And the green line, even the green line, time, is it a good time or a bad time over the next 12 months to make a major purchase? You can see that too took a drop back. Everybody was concerned about what was going to be in the budget. It will be really interesting to see what the next set of numbers from GfK look like, and they come out on December the 19th. We will obviously review that in our January numbers, because that'll give us a really good steer for what we're going to see in the first quarter of next year. And this line continues to stay up there. That's when GfK asked 2,000 people, are your personal finances going to get better or worse over the next 12 months? And you can see it's about level. It stays about level. People are resilient, even in the teeth of the issues over tax and employment and so on. You can see that that's still staying there around about level. Quick look at the major indicators nationwide. This is obviously just out these latest numbers, and this took a drop back to where I was expecting it to be. So it dropped. So although the average price, excuse me, the average price blipped up in the month by a tiny amount, it meant that the annual rate of inflation dropped down to 1.8%, which is coming in line with exactly what we forecast here on MarketCast this time last year, last December. You can go check it out. It's still online, I promise you. So this is something that we expected. Also quite interesting, I chopped this chart out of another part of the nationwide report and I stuck it on the front page so you could see it today. Look, that's the number. That's the percentage of properties in the UK. The blue line is England. The blue block is England. The yellow block is just London. That's the percentage of properties in the UK that are going to be affected by the mansion tax, values over 2 million. It's not a lot, is it? What a ridiculous measure to take to raise, I don't know, 400 million. A bagatelle. The Rightmove asking price index fell in November. No surprise there. It normally does fall in November, but it doesn't normally fall by 1.8%. So that number came down more than we expected, but it's absolutely in line with what's going on generally. And if you look at the Zoopla numbers, which interestingly, their October numbers stayed at 1.3% inflation for the year. Don't forget, their algorithm is a combination of asking prices, mortgage approval, sold prices. So I think it's one of the better algorithms. Stayed at 1.3%, pretty much exactly where we thought a MarketCast it would be. And you can see down here, though, that house prices in the southern part of the UK dipped for the first time in 18 months, but prices elsewhere are still rising by up to 3%, according to Zoopla. And that gives us these regional variations. One of the worst and most difficult markets in the UK at the moment is right where I'm standing. According to Zoopla's national index, sitting at -2% at the moment. So prices going down here. Perhaps that's because I'm here. No. So we always like to look at this indicator on Zoopla. This shows us buyer demand 12% down on where it was compared to this time last year in 2024. Flow of new supply 8% down. Stock has risen, hardly surprising. If your buyer demand is lower by 12 and your supplier is only lower by 8, you're going to have more stock, obviously. Sales agreed down by 4%. This is not a surprise. You're all feeling that out there right now. And I feel that pain too. A quick look at the RICS. I've literally just put one chart in here because here's the thing about when we talk about the estate agents and Property Mark, by the way, which I've not included in here, have shown their numbers are a little bit out of date. The latest numbers are September numbers, but only 1% of deals done in the UK in September were done at above asking price. And there is a sort of symbiosis, isn't there, between the surveyors in the RICS and the agents who they work alongside. They have to live with each other, and yet the surveyors are always so downbeat no matter what happens. Buyer demand continues to soften, they said in their October survey numbers. It's quite a big survey as well. 476 branches represented in there. Again, that comes back to that symbiotic relationship I was mentioning earlier. And if we look at what they're saying about where volumes and where prices are going to go, in terms of volumes, well, the RICS have us moving into negative in the short term. Well, no surprise there. But it'll be really interesting to see what they say in their December survey and if they agree with me. But you can see that on an annual basis, in terms of volumes, they see an increase. I certainly see an increase in volumes in 2026, that's for sure. And in terms of values, the way that prices are going to move, short term, 3 months, the majority of agents questioned in or surveyors questioned in this survey said that they felt that prices were going to fall in the 3 months. And yet over the 12 months, so that's up to December 2026, they see prices going up, prices rising rather than falling, which is hugely interesting. All right, I have dashed through that deliberately because I wanted to give myself a little bit of time. I don't want to turn this market cast from what the market's going to do into a market research program, but this research that we did immediately following the budget, I think, is crucially important. It felt to us like a bit of a non-event, a bit of a damp squib, but what did it mean to those key audience groups that you're talking to on a daily basis? So we set up a synthetic, so an AI-driven set of discussion groups, and we included first-time buyers, we included second steppers, and we included downsizers in that, just to get their feedback from the results of the budget and how it would affect their property buying process, their property buying plans. That research document is quite a big document, so AF clients will get to see the thing in full. For today's market cast, I've just given you a little snapshot, and I'm going to rush through these slides in the deck. Feel free. This market cast will eventually go up on YouTube, so feel free to hop up on YouTube later, and then you can freeze frame and look at it in some more detail. And there are some bits and pieces in here that I've not bothered to extrapolate in terms of delivery of a marketing message, because that's going to come down to each individual developer and each individual development. Regular viewers of MarketCast will know I'm an absolute believer in micro marketing. I think that's so important. So a quick snapshot of what we did then. 3 groups: first-time buyers, second steppers, and downsizers. Groups of 12 in each group, 25 to 35 in the first-time buyers. You can see that. I won't bore you with the detail there. Just as a snapshot for you, how did you rate the budget? Well, pretty much 5 out of 10, roughly 4.8 out of 10. That's how they scored the budget. And then what confidence did it give you in the property market over the next 12 to 24 months? 4.2 out of 10. So it was like that classic damp squib gave us a very significant and very obvious thumbs down from the people that we had in the group. And in terms of, if I wanted to try and gather together all of that information for you and give you back one thing that should inform your thinking certainly about your marketing in the short term, it would be this: that although the direct financial impact from this budget is actually quite limited, even if you've got a £3 million house, you're not going to feel the effect of that until 2028. It is still there. And what it is, it's more a psychological impact. It's emotional. And that emotion and that psychology that came out of the things that the government didn't do, or the Chancellor didn't do, as much as the things that she did do, is substantial. That came across very, very strongly. And uncertainty about what future policies. So that's this year done. But in terms of, will my house in a few years' time have crept up into that value? 800,000 now, where will that be in 10 years? That sort of thing. Anxiety about making the wrong decisions. They don't necessarily, our discussion groups didn't feel that this was now nailed down. It all feels, there's been a lot of U-turns in this government, and it feels, they all feel that although this was the budget, and there we are, these are the measures announced, that everything could potentially change. Certainly on the part of first-time buyers, an inbuilt resentment at the lack of help to get on the housing ladder, such an important aspiration for young people, and a resentment that there's a lack of help there. And then there is this confusion, their worry about how stable the market is going to be going forward. Now, what that means is that in terms of marketing message, emotional, their practical support's obviously very, very important. First-time buyers particularly, second steppers, part exchange and so on. But emotional reassurance, so that imbuing prospective buyers with confidence, that's the real key. So I thought this was interesting to include as well. What did you remember about the budget? Now, bear in mind that this survey was literally 3 hours after the Chancellor sat down after having delivered the budget. 94% of the discussion group respondents remembered that they didn't do anything with stamp duty. So the point that they remembered more than anything else is something that they didn't do. And that goes to show you how important it is. You will know, certainly all the housing professionals out there will know, stamp duty is the second most hated tax in the UK. What's the first one? It's inheritance tax. We all know that, don't we? But 94%. There's a massive clue there in terms of marketing message, isn't there? That's how important it is to people. That's something that we need to get our head around. A quick skip through the key points from the three groups. And please, I have stripped out of this deck here the marketing message suggestions. So in other words, the conclusions of what we've done here, these are the marketing messages you could do, because they're going to differ for all of you, and your own marketing consultants and what have you will actually help you with those. I've also, then all of these groups came around to what they thought would be the breakthrough triggers for them. The triggers that convert hesitation into action. That's really important. But again, they will differ for everybody, and I'll leave you down to find your own individual ones there. But a really quick trot through here. First-time buyers after the budget were left frustrated and feeling it was urgent that something be done. Disappointment, urgency and anxiety were the primary emotions that they showed. And the key quotes that we picked out from the quotes around the group, I've been outbid again. Somebody that didn't have enough buying power. Prices keep rising. I feel like I'm running out of time. So in terms of what they want, first-time buyers, deposit assistance. 78% of the discussion group were really vociferous about this. We need help in finding a deposit. It's impossible to pay rent and save it. We all know this stuff, but that's become even stronger and even more pronounced post-budget. Energy bill guarantees. So you telling me that this will do this? Can you guarantee my bills will be here? Again, something that's really straightforward to do. Mortgage rate subsidies, mortgage rate help. So in other words, fixed costs. Remember that uncertainty. Transparent, no hidden transaction costs, and testimonials from people that have actually done this via social media, which of course they all absorb. Second steppers, well, their reactions, primary emotions, anxiety about the tax thresholds. Don't forget the fiscal drag, by the way. So even though income tax rates weren't raised, by leaving the thresholds where they were, more people get dragged into income tax than were ever there before. Protective of the interest of their family, obviously. A couple of classic quotes here. 800 grand today could be 2 million in 15 years. This mansion tax is a time bomb. Now that's an interesting thing. If my house sale was certain, I'd commit tomorrow. The PX thing kept coming up again and again. And we're now capping our search at 700k when we'd originally looked at 850. So some interesting stuff, and some easy takes out of that then. Part exchange guarantee, 85% of respondents valued PX. School catchment area, a big deal to the family people around the table. Price freezing while they're selling. So I'll commit to doing this if you can commit to that being the price. That came up again and again. Chain coordination support. a future proofing against tax threshold rises. A really quick look then at downsizers. Love that downsizer. He's great, isn't he? AI generated. Primary emotions, resentment. Downsizers and older people feel targeted. We do. And risk aversion. And so the key quotes: we're being punished for our success. Our house appreciated through no fault of our own. The hassle of moving outweighs the benefits. Now, hassle, that hassle word came up again and again and again. Do I want to go through this? If someone handled everything, I'd pay whatever it costs. That was really interesting. So the takeouts on that: stamp duty contribution, contribution or exemption, massive deal. They think that's a huge waste. A downsizer is that stamp duty. 89% wanted that. Concierge moving services was one of the highest priorities. Property purchase guarantees for current homes, sort of PX or estate agent deal or something along that line. Quality insurance and extended warranties, and urgency narrative. So they want to beat this April. They want to get their property sold because it might qualify for that mansion tax come April 2028. And that's even if the government don't necessarily change their mind. Okay, so that's a really quick rush through, but there's another very important thing with only 4 minutes left to run this morning. We've got blocked hose syndrome going on. Someone is stood with their foot on the hose, or has been. The Chancellor has had her high-heeled shoe stood on the garden hose, reducing that water flow to a trickle. And when the foot comes off and the hose flows, you need to be ready for it. And what happens, and I can tell you this from absolute experience, that whenever the market gets difficult, the majority of buyers shift from being wants-based buyers to needs-based buyers. I dug back in MarketCast in February 2023. I gave you this. This was a piece of market research done by a big house moving company called Harrodynes in South London. And they listed the 10 top reasons that people gave them for why they were moving. And I just applied to those, whether that was a needs-based or a wants-based move. Here's the thing. If it's a wants-based move, the situation that we've had with budget paralysis, people just say, well, it would have been nice to move to somewhere that's there. But you know what? We can live without that. If it's a needs-based move, we need another bedroom because we're going to have a baby. Well, in that case, then nobody backs out of it. You're still having a baby, whether Rachel Reeves has introduced a stamp duty cut in the budget or not. You are still having a baby. And that wants-based move, that particularly a group, that particular audience are still there and are coming onto the market in the first quarter of next year and represent a significant opportunity. Also, take the good news out of the budget. One of the things for this mansion tax, everybody thought it was going to kick off at 500,000, and it actually kicks off at 2 million. So Zoopla published this chart, which I thought was great. It shows that 210,000 households who thought they were going to get hit by mansion tax now won't be getting hit by mansion tax. So that's another really good reason why confidence is actually quite high. Confidence is up. So here goes my matrix. This is where we were back in last December 2024. You note there's no uncertainty box on there. This is where we are right now. The uncertainty index, which was right down here before the budget. Now the budget's happened, it's moved back here, but as you could see from that research, people are still uncertain to a large degree. The stamp duty changes are still in negative, but at least now people know what they were and what they are, the fact that they're not happening. And you can see here, homeowner costs, general inflation and mortgage rates are all coming towards the centre. For me, this paints a picture of the opportunity with part exchange, financial deals and discounts for you to swing that market in your direction and to steal market share off the second-hand market. And don't forget, you're going to have the best opportunity ever in the first quarter of next year. Be nimble, be decisive, be quick. Really fast, how did we do in 2025 and where are we think it's going in 2026? Well, I don't need to spend any time on this because all the solid blocks now are done. That's happened. That was my original forecast for December 2025 that I set back in December 2024. and I'm leaving it there. Other forecasters who shall remain nameless, Savills, Night Frank, Savills, have changed their forecasts 3 or 4 times during the year. Stick with MarketCast. That's all I'm saying. So what about next year? Well, I'm seeing that the first quarter is going to be good. And I'm saying that the prices are going to be underpinned. And even though there was an unexpected uplift in the first quarter of last year, I think we will see that again in the first quarter of this year. And I think this is how we're going to see average prices going. And this is where we're going to see inflation going. However, cloud on the horizon, I do think it's going to be a difficult summer. I think that once we've seen that pipeline flashed through, and we get back to the regular flow, if you like, I see that the summer's going to be difficult. It means it's very, very important that everybody takes advantage of the opportunities presented in that first quarter and try and forward sell to a large extent. Ending the year just about in positive. Not quite as much in positive as we have done this year, but of course, nobody can see a year ahead. I mean, there is an element of luck in that, even though I have to say so myself. Okay, so in summary then, just run about a minute over. The budget was a non-event, but the market was suppressed in quarter 4. And this has created the conditions for a strong quarter 1 if you go out and grab it. So make sure, so this is comms, isn't it? This is communication. This is time to talk to the sales teams to make sure that they understand the opportunity that is writ large for everybody out there. Over the whole year, I think 2026 in terms of prices is going to be sort of flat, but I do believe we'll end up in positive in inflation. I think the forecast of 1.2 million transactions for this year is going to be a bit under pressure because of the budget wobble that we've had over the last couple of months. Even though mortgage completions have come back a bit, I think that could be a bit in jeopardy. I think next year we could see 1.3 million transactions. So that will be very interesting. New homes, I think, should finish above their long run national average, 11, maybe even 11.5%. 2026 volumes look to be around long-term average, maybe just above it. Okay, that's a real dash through because we did the research piece. AF clients, you'll have access to that research piece in full. Thursday, the 8th of January, that's our next market cast. All it leaves for me to do is to say, I hope you love the Christmas shirt. Have a fantastic Christmas. Make sure you spend it getting your plans ready for quarter 1 next year. And I'll be back in 2026.